Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. This is going to be a short and sweet video, and in it we're going to be discussing why learning how to invest properly through value investing is going to be the most important financial decision you're ever going to make. So, um, when it comes to investing, you always have a couple of options. You can go with, mutual funds, you can put your money into an index fund, but really none of those are going to give you the results that being able to invest your own money properly ultimately will. And I'll show you what I mean here. So I have a compound interest calculator, and we're going to assume, worst case scenario, you have no money now. Okay, you have no money. You're dead broke, whatever the case may be. Maybe you're in your late teens, or maybe you're in your 20s or 30s, or whatever the case may be. But you're able to put aside $1,000 a month, so $12,000 a year in terms of your savings moving forward. And we're looking at basically a 40-year time horizon, so looking 40 years down the road. Now, assuming you just invest, let's say, through a mutual fund or something along those lines, which is not wrong to do. I'm not saying it's horrible or a bad decision or anything like that. You probably will get something along the lines of a 9% return, meaning, 40 years from now, you'll probably have about $4.4 million available, right? And this is good and everything, but let's say you decide, hey, I can make more money than that. I'm going to be able to set aside $2,000 a month. So I'm going to set aside $2,000 a month, $24,000 a year. So I'm going to have $8.8 million when I retire, right? And that's fantastic. There's nothing wrong with that. You're setting money aside, you're investing it. That's good. But the point that I want to show you here is when it comes down to this rate of return that we're getting, let's say we get 9% through an ETF over a long run, like an S&P 500 index fund, or through a mutual fund. Let's say we're able to get 15% per year, which a really good investor, somebody who spends their time studying and learning, is able to do. And let's say instead of $24,000 a year, we go back and say, you know what, we can only save $12,000 a year again. Look at the results. Even though we're saving half as much money, so $12,000 a year, we're getting significantly more in the future. We're able to get $24.5 million in 40 years' time. So let's say, but instead you had 24,000, but you only invested it, let's say through an index fund, you didn't learn how to invest properly, you have 8.8 million. So what I'm saying is you can get basically 3 times more money even though you're investing only half of the amount if you learn how to invest properly and you do it early enough. But in order to invest properly, you're going to have to really study, you're going to have to learn, you're going to have to work hard towards your goal, and you're going to have to read a lot of books and a lot of accounting material and so forth. And it takes a lot of time. So you have to decide if this is something you're going to commit yourself to, but if it is, the reward is definitely there. It's going to take a little bit of time to get there. So keep that in mind. Learning how to invest properly is going to be one of the most important things that you can do, because you're able to compound money at a higher rate, which is really what's important when it comes to the long term. Before you make any financial decisions, it's always good to talk to a financial advisor first. That's something that you should do. So don't take this video as financial advice. The only thing I'm trying to convey here is that compounding money at a higher rate will almost always be worth more than making more money in the short term, in the long run. So even if you make twice as much money, if you had the choice between making twice as much money or saving twice as much money and being able to compound money at twice the rate, you would choose to compound the money at twice the rate, provided that your time horizon is far enough into the future. So keep that in mind. I hope this video was informative, and we'll see you next time.